What if I told you that right now, behind the scenes of the financial world, an interesting competition is taking place, and it's not between countries, but between major financial players focusing on one single asset, Bitcoin. On one side, you have the world's largest asset manager, a trillion-dollar institution influencing global markets. On the other side, a company that has gradually shifted from a traditional software business into a Bitcoin-focused organization. This is not just a simple comparison. It's a developing trend that could influence how Bitcoin is held over time. As of mid-March 2026, BlackRock's iShares Bitcoin Trust holds more than 784,000 Bitcoins, while Strategy, formerly MicroStrategy, holds over $761,000. The difference between them is relatively small, at around 23,000 coins. At Strategy's current pace of buying, this gap could narrow further in the coming days. This is one of the reasons why this situation is getting attention, as it reflects a broader shift happening in the market. This content is for educational purposes only and should not be considered financial advice. But to really understand why this matters, you need to look at one simple fact. Bitcoin's supply is fixed. There will only ever be 21 million coins. That means every Bitcoin being purchased by these large entities is permanently reducing the amount available in the open market. This is what creates a supply squeeze, a situation where demand keeps increasing, but available supply keeps shrinking. And right now, that squeeze is no longer theoretical. It's actively happening. Now, at first glance, it might seem like both BlackRock and Strategy are doing the exact same thing, buying Bitcoin. But in reality, their approaches are completely different, almost opposite in nature. BlackRock isn't buying Bitcoin for itself. Instead, it created a financial product called the iShares Bitcoin Trust, or IBIT. This allows investors, both retail and institutional, to gain exposure to Bitcoin through traditional financial systems like stock accounts. Here's how it works. When investors buy shares of IBIT, Bitcoin is purchased and stored on their behalf. When they sell, Bitcoin flows back into the market. So BlackRock's Bitcoin holdings are not based on its own belief or strategy. They're driven entirely by investor demand. If demand increases, holdings go up. If sentiment weakens, holdings can shrink. In simple terms, BlackRock is acting as a gateway, not a direct risk taker. Strategy, on the other hand, operates with a completely different mindset. It doesn't wait for demand, it creates its own buying power. The company actively raises funds through multiple channels, including issuing debt, selling shares, and offering high-yield financial instruments. The goal is always the same: raise capital, buy Bitcoin, and hold it long-term. What makes Strategy unique is its discipline. It doesn't trade Bitcoin, it doesn't try to time the market, and it doesn't hedge its position. Its strategy is straightforward: accumulate as much Bitcoin as possible and hold it. Because of this, its Bitcoin balance only moves in one direction, upward. And recently, the pace of that accumulation has been extremely aggressive. In just 1 week leading into March 2026, Strategy acquired over 40,000 Bitcoins. That's an extraordinary number, especially for a publicly traded company. Since the beginning of the year, it has already added tens of thousands more to its holdings. This kind of accumulation is almost unheard of and is a major reason why the gap with BlackRock has narrowed so quickly. Right now, the race between these two giants is incredibly tight. Based on Strategy's current pace, it could theoretically catch up to BlackRock within a week. But there's an important detail to keep in mind. BlackRock is not standing still. Every single day, new money flows into IBIT, which means more Bitcoin is continuously being purchased. So while Strategy is closing the gap, the target itself is constantly moving. This creates a dynamic where the race is always active and never truly predictable. But the real story goes beyond just who ends up holding more Bitcoin. The bigger impact lies in what this means for the overall market. Between institutional ETFs like IBIT and companies like Strategy, more than 2 million Bitcoins have already been absorbed. That's close to 10% of the total supply. And most of these coins are not being actively traded. They're being held long-term in custody or cold storage. This is where the concept of a supply shock becomes important. When a large portion of an asset's supply is removed from circulation and demand continues to grow, it creates upward pressure over time. In simple terms, fewer available coins combined with increasing demand can significantly impact price movements in the long run. When it comes to structure and safety, BlackRock clearly has the advantage. It offers a regulated, easy-to-access investment option for Bitcoin without requiring users to manage wallets or private keys. Investors can gain exposure through familiar systems like brokerage accounts. And importantly, even if Bitcoin's price drops significantly, BlackRock itself doesn't carry that risk directly. The assets belong to investors, not the company. Strategy, however, operates with much higher risk. The company has taken on billions of dollars in debt and continues to raise funds to fuel its Bitcoin purchases. Some of its financial instruments come with high yields, which means ongoing obligations. Its entire model is closely tied to Bitcoin's performance. If Bitcoin remains strong, Strategy benefits massively. But if the market enters a prolonged downturn, the pressure on the company could increase. At the same time, this risk is also what creates opportunity. Because Strategy is effectively leveraged to Bitcoin, its stock performance often moves more aggressively during strong market rallies. This makes it attractive to investors who are willing to take on additional risk for potentially higher returns. For investors, this creates three main paths. The first is IBIT, which offers a simple and regulated way to track Bitcoin's price. The second is Strategy's stock, which provides leveraged exposure with higher volatility. And the third is direct Bitcoin ownership, which gives full control without fees but requires managing security and storage. Looking ahead, if Strategy eventually surpasses BlackRock, it would mark a significant milestone, a single company holding more Bitcoin than the largest institutional ETF. That would be a powerful signal of how far corporate adoption has come. But even if that happens, the broader trend remains unchanged. Institutional interest in Bitcoin is accelerating rapidly. More companies are starting to add Bitcoin to their balance sheets, and regulatory clarity is improving. This is making it easier for large institutions to enter the market. What we're seeing is not just a short-term trend, but a long-term shift in how Bitcoin is perceived, as both a store of value and a strategic asset. In the end, this isn't just about BlackRock versus Strategy. It's about two completely different approaches to the same idea. One is focused on making Bitcoin accessible to everyone through traditional systems. The other is focused on aggressively accumulating it with long-term conviction. But both are moving in the same direction, absorbing supply from the market. And as this continues, the impact could be massive. So the real question isn't who wins this race. The real question is, are you positioned before the next major move happens? So, if you found this video valuable and want to stay ahead in crypto, market trends, and smart investing strategies, make sure to subscribe to MSTR Hub. Don't forget to like this video, share it with others, and drop your thoughts in the comments. Is this a real opportunity or just another risk? And most importantly, hit the bell icon so you never miss an update. Thanks for watching. And remember, smart moves build strong portfolios. MSTR Hub, where market insight meets strategy.